Good morning, and thanks for joining us here on Treasure Coast Solutions. Every Wednesday morning from 9 to 10 o'clock, we talk about things that are of an economic nature, a finance nature that might impact you and your lives. And we're not a financial planning show, although hopefully the information that you get from the show you can use to make some planning decisions and take advantage of that opportunity. But I but the primary purpose of the show is to kind of talk about some of the economic things that are taking place and what happens and what is going to maybe occur, what's going to affect us here in Stewart, what affects us as a country, what affects us as part of the world, all of those types of things. And today we're going to talk about really one of the main economic issues that impacts all of us, and that's taxes. And what I'm going to talk about, because it doesn't do any good to talk about taxes that exist, we're going to talk about taxes that are going to exist. And so today, I'd like to go over a little bit about or I'd like to spend the time going over what is being proposed in this budget bill as increased taxes. A lot of people don't realize that the tax bill is already out there. It's sitting in committee, and it's already been marked up or is being marked up, which means that it's being pushed through as a bill to become law. So we're gonna talk about that this morning and some of the specifics. And if you want to call in, if you've got a question about something, feel free, 220-9788, 220-WSTU. You may have questions because some of this stuff is going to sound unbelievable. But anyway, my name is Mark Breckbill. I'm a CPA and ex-banker. Have been involved in small business for a long time, 25, 28 years here with my practice. I do a lot of consulting work for clients, both tax and business consulting, asset protection, which encompasses protection from taxes, protection from creditors, and also help with some of the financial issues that clients deal with, buying and selling businesses and state issues and all of those kind of things. We're kind of a full service consulting and tax firm. But and one of the complaints that always occurs when I talk, it seems like no matter what I say, is that, gee, Mark, you're depressing. And the funny thing is, I actually am a pretty easygoing kind of guy, but I do probably one of the most horrible jobs for a living, and that is dealing with the U.S. government, the IRS, and taxes, because it's way beyond finance. As a CPA, I got a lot of finance, economics background on that, but but unfortunately, the tax code has become the primary means to implement social change that people want to implement, which doesn't have anything to do with raising revenue. The tax code initially was set for the purpose of raising revenue, and that's what its purpose was, and so it did it as efficiently and effectively as possible. But when people realized that you could accomplish other things with the tax code that you might not be able to accomplish with the legislature and might not be able to get passed, but you can make it happen just by having it be implemented through the tax code. And I think that the current administration, and actually others as well, saw the power of the tax code for social change with the Affordable Care Act. And as many of you may remember, the Affordable Care Act, also known as Obamacare, whatever you want to call it, the Affordable Care Act was unconstitutional the way it was actually written. And I know people are jumping on, no, they went to it was unconstitutional the way it was written. The government said it was not a tax. The government said we have the power to force people to take insurance. We have the ability to give them a credit for doing that. We have the ability to charge them a penalty for not doing it. We can force people to have insurance, and we can force them to do something in their personal lives that they don't want to do. We have the ability to do that constitutionally. And the Supreme Court said, no, you don't. But that's not how the answer came out. What that and this is what many politicians learned, and what is the scariest thing you can think of is that Chief Justice Roberts said that we don't have the ability. You don't have the ability to do this. You don't have the ability to force people to take health care. But you do have the ability to tax them. And this is a tax bill. It's not a health care bill. It's a tax bill. Even though you said it wasn't, even though you swore it was a health care bill, we, as the Supreme Court, actually just him, are telling you that, yes, it is a tax bill. And because it's a tax bill, you have the authority to do whatever you want tax-wise. You passed it. The House passed it. That's where taxes come from. It was, and it became part of law, and it became tax law, not because it was written as tax law, but because that's the way it could get implemented. And the Chief Justice at the time had no intention of actually ruling on the law. He had an intention of coming up with a political answer, and he didn't want to come up with an answer. He was afraid what would happen with the Supreme Court if he didn't come up with the answer that the public wanted. So he was an accessory to using the tax code as a tool against the public. And that's exactly what happened. And when that happened, I know I mentioned, and I know a lot of people mentioned as well, this is the scariest thing that could possibly happen. Because when the Supreme Court basically says that the government, through its taxing arm, and the IRS and Department of Treasury, has the unlimited ability to do whatever they want as long as they call it a tax, it sets you down a path that you cannot get away from. Because at that point, there are a number of things that, if shown the daylight, would never pass. You cannot get them voted in. But if you hide them in a tax strategy, if you hide them in a tax bill, they can become law. And so you can implement social change via the tax law that you could never get implemented via Congress. And they knew that, and they've learned that. And that is a scary thought. It means the IRS has unlimited power in this country. More power than the military, basically. I mean, even the military can't go to war unless it's declared, technically. But the IRS could go to war if it was probably couched in the method of a tax. If you said, Iraq isn't paying the taxes that they should to us. There's companies over there that, they're supposed to be sending us this new corporate minimum tax. We're going to go over and collect it. And by the way, the IRS needs 18 million new tanks and whatever. So when you watch and you're looking at these tax bills, and there's additional money in there for tax administration, think about what they could do with that money under the guise of using it for tax administration. I'm kidding, of course, but it's true. I mean, I'm kidding only because we can't believe that somebody would do that. Now, when I get into the tax law, you're going to see that this new tax law, you're going to see that people are doing stuff like that. But I'm saying that, but it really is true. If you're smart enough and you couch and you can get it through on a reconciliation bill, like it's going through the budget, you can implement almost anything, because the Chief Justice said, if it's a tax, you can do it. You have the authority to tax, and the IRS has the authority to tax and implement those taxes. In fact, what's scary about that is even if the law is not crystal clear, the Supreme Court gave the IRS, and has historically given the IRS, the ability to interpret law to implement it. And so then they have the right to say what is or isn't the way that they intend to enforce it. You have to then go to court and fight that potentially. But they're right, and until such time as the Supreme Court would say they were wrong. In the case of the Health Care Act, The Supreme Court didn't say they were wrong, and nobody saw that coming. Nobody saw that coming because the administration itself was even saying this is not a tax bill. So that's what we have as a history, and that's where we've gotten to today. People say, how do we get where we're at? How do we get to this situation where, and what you're going to see here is what we actually have is a socialist tax code that, and I'm not using that politically, I'm using that economically, a socialist tax code that implements a socialist government. And it does it very effectively utilizing the tax code. There are taxes in here that are more taxes on business and others that are more than in Cuba, than in China, in Russia. There are things here. These are draconian measures because they're implementing a complete change in society, and it's being done with the tax code. And so between the ability to spend and the ability to pay for that spending through taxes, you can do almost anything. And you don't have to pass laws as long as it's considered a legitimate government spending, a legitimate budget spending, a legitimate White House spending. It's going to pass, and it becomes law, and then you have to deal with it. So I get, like I said, I get 220-9788, 220-WSTU is the number in the studio, area code 772. One of the things when I make presentations, it's kind of a common joke that I'm depressing, and that everything that comes out of me is depressing. And unfortunately, today that's going to be absolutely true. But I will start out. I decided to be optimistic. I have a friend of mine and a colleague and a associate, Merle Dimbath, who always claims he's the optimistic economist, which is something that's difficult to be in something that refers to itself as the dismal science, economics. He's in economics. He's got a PhD in economics, and he's got a PhD in the dismal science. Yet he is the optimistic economist. I, on the other hand, am a CPA. I'm supposed to be a pretty upbeat kind of guy, just boring. And, I'm supposed to wear eye shades and little cups on my sleeves, and I'm good to go. And I actually, I'm kind of an easygoing guy. There's not things that, I'm not really a negative guy. I don't usually see the end of the world. But I also do like to look at something and see what it means. And I can see what's in here. And I know it's not hard to see what they mean because they say it. And that's what is the most interesting thing. So here's where I would, so I'm going to start out by talking about the optimistic things in this bill, the things that are positive in this bill. And I've searched through it. And so here's the positive things about this bill. It doesn't start until January 1, 2022. So we got 4 months or so. And that's a plus, because some of us thought it was going to be retroactive to the date of the Green Book, which was May 2021. And so if there's some of the stuff, so it's not. Right now, the way it's written, it will all be implemented January 1, 2021. So that's one good thing. Okay, now we're going to turn to the negative because there's no other good things. Looking in here, there is 0 additional good things. Nothing else is good. So the only thing is you've got some time to do something between now and the end of the year. And I would suggest that you take action, because if you don't take action before the end of the year, you will not be able to take action again, unless this stuff is all overturned at a later date. Anyway, so this is what's in the budget plan for fiscal year 2022. And it is what it implements. So keep in mind that we've already had a lot of other stuff. The American Rescue Plan in March, that was one that was done by the American Jobs Plan, the American Families Plan. All of those have been implemented. The The American Rescue Plan didn't have any new taxes involved with it. It didn't change the taxes. But these two new initiatives do make changes. The American Jobs Plan, the American Families Plan. So, which is ironic. Neither one of them create jobs, and they all destroy the family. But we won't talk about that. Well, we will talk about that later, because one of the things that this does is reinstitutes the marriage penalty. So one of the planning strategies I have for you right now is get a divorce before the end of the year, especially if you're a high income. And we're going to talk about that in a minute, because there's a significant penalty here on high income. So according to the Treasury Department, now this isn't me or anybody, this is the Treasury Department, which is currently controlled by the current administration. So if anything, it's probably an understatement or optimistic. There are an additional $2.4 trillion in revenue that's raised through taxes over a 10-year period. All right. And there is $6 trillion in mandatory spending programs. So, and I've actually heard that number is closer to 7 trillion, but we'll just use their number, 6 trillion. So there's 6 trillion of new spending programs, 2.4 trillion in revenue. So we're looking at 3.6 shortfall. That's a $3.6 trillion deficit every year for 10 years. Now, one of the things that every budget does is it plays games with dates. So let's say, for example, I'm going to give you $1,000 a month for the rest of your life, and I put that in the bill. Then I got to figure out the rest of the lives of all of the people, and that becomes a permanent payment. You know, I have to figure it based on that. It becomes a permanent payment. I put it in here. I put it in the bill, and I have to factor that in for the next, gazillion years. But if instead I say, well, we're going to do that, but we're only going to do it for 2 years, or we're only going to do it for 4 years. Well, then I only have to do 4 years worth of that. So my overall spending goes down because I'm only going to do it for 4 years because the budget has to be over a 10-year period of time. So what they do, they look at the effect over a 10-year period of time. So because 10 years is the longest horizon that they look at, if you shut stuff off before the 10 years, you can make your numbers better, even though you're actually spending more. It's basically a cliff funding type thing that, if you're familiar with retirement accounts, where you boom, all of a sudden you fund you're funding nothing on it. And so that's what they've done here. So when I say that 6 trillion is a mandatory spending, it's actually larger than that. But they cut it off before the end of the 10 years. Now, if I give you, let's say $2,000 or $3,000 a month for the rest of your life, are you going to vote in favor of taking that away in 3 years? Probably not, because it's going to become part of your budget. It's going to become part of what you need to survive. You will have adjusted your living habits based on that. So they know that. So they know that many of these mandatory spending programs will have a cost way greater than the number that they're putting on it. But the Treasury is supposed to, and the Congressional Budget Office is supposed to use only the 10-year horizon. So they are not, and what it actually says. So they can't say, well, geez, in 5 years from now, when this thing runs out, it's going to be renewed. They're not allowed to do that unless the government says we're going to renew it. So that's where we're at with it, is the numbers. All right. So, the first thing is, what are we doing? What are we doing with high income taxpayers? What are the individual tax rates? Well, before you look at the individual tax rates, you actually have to look at what is the definition of wealthy. And this has been defined. And I've been saying for a while, the tax code has defined wealthy for years. But politicians throw that term around because people don't think in numbers. They think in abstracts. If they think wealthy, they think somebody who sits at home, has a Rolls, clips coupons, has everything and all kinds of money, and makes millions of dollars a year. they think of the Bill Gates of the world, and they think of the, all of those kind of people. Well, I got news for you, people. That's not who it is. The wealthy, and it actually is the top 1%, pretty much. It is the people that have been paying a lot of the taxes to start with. Wealthy is now considered to be an individual, an unmarried individual, who makes $452,700 or more. So you can say, well, that's a lot of money. Well, that's a lot of money if you were making that every year. But the fact is, most people don't make that money every year. They're just making it every so often. So say, for example, I've had a business that I've operated for 20 or 30 years, okay, and I sell it for $5 million. I've done this for 30 years, and all I've got is my business is worth $5 million. So I may still have a mortgage on it. In fact, with the economic injury disaster loans and all of that, I may still have a loan on it. But because that year I'm going to record $5 million worth of gross income and some amount of net income over 452,000, I am now wealthy, and everything in this code applies to me. As a wealthy person, I am now the rich, the cream of the crop. Now that's $452,700 for an unmarried individual. So what would you think that the married threshold would be? Well, probably almost 900,000, right? 452 times 2, I'm thinking $900,000. No, it's $509,000. It's only $50,000 more. So what are you going to do if you own a business and you're getting ready to sell it, and you're going to get taxed at horrendous rates because you are going to be above that 509,000 or the 452,000? Well, the first thing I'm going to do is, split the business between myself and my wife, or whoever I choose at that time, and then divorce them, with an understanding that I get that money back. But so now divorce is a legitimate strategy for saving taxes. That is not really, that's one of the bad strategies for saving tax dollars, is to have to get a divorce. There's a few things that make bad tax strategy. One is forcing people to get divorces to save taxes. Two, forcing people to have children to get money. That's not a good one. And three, forcing people to die to take advantage of something. Those are three of the bad things that are in the tax codes, and we have them all back. So they're all there. But anyway, so that's the definition of rich, and there's now a marriage penalty back in here. The top tax rate is 39.6%, except if you have net investment interest tax, the NIT. That's another 3.9%, and so you're actually up at about 42%. Actually, you can be around 40%, 40.8%. Plus, you can have Social Security taxes added on there at another 3%, which will probably go up. And so you're actually looking at an effective tax rate close to 50%. So just about half of every dollar you make will be going to the United States government, and you won't get to keep it. And that's a shame, because some people are working all their lives. Now, why do you want to have a business at this point? It's a really legitimate question. If the only answer I could come to, and I've been thinking about this for a while, why would I encourage my clients to have a business, buy a business, own a business, do whatever? I certainly would encourage them to sell their business right now. But why would I encourage them to buy one or keep one? The only answer I could come up with is that this can't last long. The economy collapses within 10 years, the government is overthrown, and you have a new regime in. The question is, and I'm literally talking about that. That's where you have to go with something like this. The only way things like this ever get undone is revolution. It's overthrow. That's what has to happen. People don't voluntarily, when you've made every single person, every single family dependent upon you for income, um, you do not get, you don't get out of that by just voting out of it. People don't vote against their pocketbook. They don't vote to be poor. If somebody's getting by now because they got more money than they were getting before, maybe they were young and in school or trying to get a job or whatever, and now all of a sudden they've got money. Well, there was no incentive for them to go out and get another job because they've already got money, right? And so, um, you know what what happens at that point? Well, you don't vote against that. You like that. In fact, right now we have a population of younger workers that are using what I call just-in-time employment. In other words, people aren't going out and getting jobs now with the idea of being there for 20 years or being there. Frankly, they're not getting jobs with the idea of being there 2 years. Many of them are there to make enough money to be able to afford someplace to live, not necessarily where they're working, and to do the activities that they want to do. And they will work long enough to get that, and then they stop for a period of time and take off. And then they go back and get another job again. They're not looking to amass wealth. They're not looking to buy houses and real estate and amass wealth. They're just not looking at that. They're looking at, I need money to have some fun. I'll go out, do some skiing, you know, smoke some pot, maybe, go out and party and have fun. And then I'll go back out and do it all over again. And as soon as I run out, I go back and get a job. They're well educated. They have decent degrees. They may have skills, although they're not trained skills at this point. The employers probably spent a lot of money getting them up to speed and then loses them. So they spend a lot of money on employment costs. But the bottom line is that's what people are happy with now. They don't buy material items. They're not buying cars. They're Ubering. They're not buying houses. They're renting. All of those things. We don't have people into the diamonds and the furs and all these kind of things. People are basic, and in some respects that's a good thing. But from an economic standpoint, when you're looking at controlling those people, they don't need as much money. They don't need the reward. When somebody's looking to start a business and make that business bigger and profit from it, they're looking long term and they're doing things that have a long term benefit. This is a short term economy right now. And so it's going to be easily controlled by taxes. So that's where we're at with the rates. And so I'm going to go through and kind of cover some of these things. We've heard about capital gains, long-term capital gains rates and qualified dividends. They're taxed at a maximum of 20% right now. That's going to go to 40.8%. And that's if you're subject to the 3.8% net investment income tax, that NIIT. Now, it's only to the extent that you exceed $1 million. So, but think about long-term capital gains. First of all, you had to hold them more than a year. And second of all, that's the whole idea. It's something that's got value and that's increased in value over the years, and now you're going to sell it. And so you were encouraged before because of the rates, you were encouraged to allow that to increase in value. Now you're not. Now you're going to get taxed on that. And it's going to be and you're going to get taxed at a very high rate. Anything over $1 million. So again, let's take the example, $5 million, sold my business. Maybe $3 million of that was a piece of property that I owned in the business. It was the office or whatever, and it's worth $3 million. And so I got $5 million total. I sold that. It's all long-term capital gains. Well, $4 million of it, I'm going to pay 40% tax on $4 million, where I was going to pay 20% tax. So I've just paid $800,000 in additional taxes that I didn't have to pay before. So that's a pretty hefty increase on people I don't consider to be necessarily very rich. I know a lot of business owners who have owned their business real estate for 20 or 25 or 30 years, have kept it up, have paid for it, and it's worth, $4 or $5 million, especially in today's market. Here's a big deal that's going to affect a lot of people. It's called the repeal of the carryover and stepped up basis rules. So here's what happens. If I die, and I own a business, right? Um, and I don't have, and that business right now isn't over $11 million. My total estate's not over $11 million. I'm not paying any estate tax, and I'm going to uh, the business, which again might include real estate. If my kids are going to sell that, um, their value of that business is the value as of the date I died. In other words, I'm allowed to, they don't have to pay any tax on all of the equity that I've built up in the company over the years and left into the company. They don't have to pay that. So um, that's called stepped up basis. That's why you can inherit money from your friends and relatives and others. That's why you can inherit money and you don't pay any taxes. You don't have to pay the taxes. The people that would have to pay the taxes are a person that give the gift. Or so now what's going to happen is that if you if you gift an asset, you're going to gift the basis of the asset, not the fair market value. You're going to have to pay tax on the difference right away, uh, on gifts and on estates. So not only do you have to pay it on somebody's death, you're going to have to pay that tax. But if I give the asset to my kids before I die, they're going to have to pay the tax. Um, there's so there's no way to. So what it boils down to is every family business is going to be subject to a tax. There's provisions in here for that to be spread out over a period of time. You can pay it out over 15 years. So you're going to give your business that you've worked forever to your kids so they can continue to work that business and make an income off of it. But they're going to pay, they're going to start their chance of taking that business over with huge amounts of debt for taxes to the IRS. And the IRS has the ability to secure that tax however they want. They can take mortgages on your property. They can take equipment. If they think that there's a question about the collection of the tax, they have the ability to secure that. So that's bad enough. Now, here's the one I like, because this is the killer. This is the provision that causes every business to leave this country in the next 9 years. And I said 9, not, and so I'm going to. So if you have a trust, a partnership, or any other non-corporate entity that has not been subject to a recognition event, that's where you've had a tax as a result of step up in basis that you have to pay the tax on. If that hasn't happened, and because it's been in a partnership entity or a trust, again, a trust that you have not sold or sold the assets or had a recognition event, you're going to have to pay that tax and create that recognition event if you haven't had that event within the prior 90 years. 90 years. So all of you just shut off and said, oh, 90 years. Come on, that's a long time. Here's after the comma, prior 90 years, comma, with such testing period beginning on January 1st, 1940. So the 90 years started January 1, 1940. Where are we at? So we're talking 2030, 9 years from now, not even 9 years from now, every partnership, trust, or non-corporate entity is going to have to reset all of their and pay taxes on all of the value of their business. They have to have appraisals done to do that, a business appraisal. They have to have real estate appraisals. They have to have equipment appraisals. They have to have, it has to be an asserted value that's supported by appraisals, by legitimate appraisers, and it all has to be done in the next 9 years. So now, how do you leave the country if you're an individual or a business? Well, you have to pay tax on the fair market value of your assets. Well, if I'm already paying tax on the fair market value of my assets, then I can get out with no additional cost. So if the government's going to make me pay this tax in the next 9 years, That's when I can leave this United States and go to a country that doesn't have a tax. And I can do that without ever leaving the United States, believe it or not, because all I have to do is move my entity offshore and I never pay tax again. I have to pay tax when I move it offshore, but I never have to pay tax again. So I go to a place where I'm protected, Cook Islands, and and it doesn't have a tax and never will. And I invest that money through Switzerland or any place else. Could actually own property in the United States. I might have to pay tax on something that happens in the United States, but I don't have to pay tax on everything that happens in the United States because I'm no longer a U.S. entity. And so that is what's going to happen somewhere prior to January 1, 2030. By December 31st, 2029, we're going to have a mass exodus of trusts and partnerships and other entities moving offshore. But say they don't have to deal with that. There's an expansion of the 3.8% Medicare tax to additional taxpayers. So now any trade or business income of high income taxpayers, $450,000, would be subject to a 3.8% Medicare tax. So that is the 2.9% Medicare tax on all employment earnings, plus the 0.9% Medicare tax imposed on self-employment earnings and wages of high-income taxpayers, either through the NIIT or Self-Employment Contributions Act. In particular, for taxpayers with AGI, adjusted gross income, in excess of $400,000. Now that's AGI, not taxable income. So that means taxable income lower than $400,000. The term net investment income, as used in Code Section 1411, would include trade or business gross income and gain not otherwise subject to employment taxes. In addition, limited partners and LLC members who provide services to and materially participate in their partnerships and LLCs, as well as S corporation owners who materially participate in their trade or business, would be subject to seek a tax on their distributed shares of the business's income to the extent that the income exceeds certain threshold amounts. Okay, so what that says, translated, what that says is many of you have S corps because you pay yourself a low salary that you pay Social Security taxes on. And then the rest of the money you take out as a distribution that you don't pay Social Security tax on. You still pay income tax on it, on the income itself, but you don't have to pay Social Security taxes. Now you will pay tax on Social Security tax on everything. S corps, it doesn't make any difference what you pay yourself a salary. You're going to pay Social Security tax on all income from an S corp. All income from a partnership, including a limited partnership, is the way that this is structured. If you materially participate. So if it's a partnership or an S corp where you work, where you're there, you're going to pay that tax. And that is huge. They've been trying to get that through for years because they miss out on a lot of income. There's a lot of Social Security income that they miss out on because of that. Okay, so that's kind of interesting. There are the biggest thing that's in here is the repeal of like-kind exchange deferrals. These are 1031 transactions. And we knew this was going to come, it was going to be in here. The question is whether it was going to be retroactive and whether it will actually get passed. 1031 exchanges are the way that businesses and individuals have transferred wealth to their family for generations. What they do is it involves taking a piece of real estate that's been used in a trade or business and rolling it into some other real estate that can be used for investment purposes to continue to make a living off of your business assets. So let's say I sell my business and it included real estate maybe that I was renting from myself, but it was a source of income. And now I sell my business, but I still need income. So I decide not to sell, or I sell my real estate because the business that's buying me wants to buy the real estate. I sell the real estate. Now if I pay tax, I've got a substantial amount of money that I can't reinvest because I had to pay it in taxes, 40% in this case. So I got $1 million piece of property. I can only reinvest $600,000 because I paid $400,000 to the government on that $1 million gain. So I'm reinvesting the $600,000 and taking that $600,000. So now I've got to make a much higher return on my $600,000. I have to take a lot more risk, probably in retirement, to make the same amount of money that I was making previously, because I had to take some of that money and give it to the government, and I can't earn money on that. That was money I used to earn. That was assets I used to earn money on. I now don't. That is going to go away. So you've got till the end of this year to do a 1031 exchange. And a 1031 exchange is a complicated process, so make sure you don't do that on your own. You need to call somebody who knows what they're doing. And that includes a CPA, includes a realtor, and includes other people, attorneys that know what's involved in a corporate 1031 in particular, but also in just an individual doing a 1031. All right. There are a number of credits in here that have been expanded in the code. And there's the child tax credit, the child independent care credit. There's the earned income credit. There's the premium tax credit, which is the credit you get against insurance. They have now they've increased that contribution so that your health insurance is less expensive, which means that now you will be forced to buy all your insurance through the exchange. You will no longer have any other option, because it will be so expensive to buy insurance outside the exchange that you won't be able to afford it anymore, because your insurance inside the exchange is going to be tax-free. I mean, it's going to be cost-free, even up for high income people, because they have now adjusted the proposal. Adjusted the eligibility level. It was limited to less than 400% of the federal poverty line. Now it is household income above the 400%. So it applies to everybody, basically. The other thing that they're doing with this is where we get our universal income. Now, I told you there's an encouragement for divorce, because if you're making any big money, you're better off being divorced. There is also an encouragement to have kids, lots of kids. Make sure they're not 17 or more, over 17. Make sure they're under 17. You get $300 a month for anybody under age 6. Now, think about that a minute. If you really work at it, you can probably get 5 kids who are under 6, and then have one in the oven ready to go. So if you've got 5 kids, you're going to generate $1,500 a month just there. And then you've got another 11 that you can get in there, that you get that you get a little less than $300 a month. Those you get $3,000 a year. So whatever that comes out to divided by 12, and probably $275 or whatever. So you get $275 for those, and that's times 11. So that's another $3,000 a month. So I'm getting $4,500 a month, almost $60,000 a year. And all I have to do is have children and not be married. And the good thing is, I don't even have to take care of the kids, because the government's going to take care of them. And so all I have to do is have them. But this is universal income, and it's provided in the form of a tax credit. Now, if they tried to pass universal income, there would be an outrage. But they have done it through the tax code, and nobody's going to notice. They have just made it permanent. Because what they've also done is increase the amount of income that you can make and still earn the maximum credit. So the phase out of that is now much, much higher. So that's where universal income comes in. It comes in based on children, and the earned income credit doesn't involve children. So it can even come in there for workers without children, because they're making that for higher income levels. So what's going to happen is people are going to get universal income in the form of an earned income tax credit or child independent care. There is a whole section on the Green New Deal, which I won't really get into. It's fossil fuel tax preferences. But what they've done is eliminate any carbon investments. They've eliminated the gas partnerships. They've eliminated gas and oil partnerships. They've eliminated deductions for drilling costs and tangible drilling costs, fracking, all of those things they've They've eliminated deductions for them, which now makes them impossible to do because they're too expensive. And then the counter is they've provided all kinds of renewable electricity transmission and all kinds of things like that. Now, for the wealthy, they've thrown in a provision for a tax credit for sustainable aviation fuel. So if you use sustainable aviation fuel, you can actually still fly your plane all around the world and generate all kinds of emissions, but you'll feel good about yourself because you're using substantial aviation fuel. And the government's going to give you $1.50 per gallon as a credit to use that fuel when you fly around telling people how they shouldn't be flying around burning carbon. So there's a low carbon hydrogen production tax credit. There's also some principal residence tax credits that they're going to give you. There's some housing credits. There's a refundable credit for homeowners and businesses in disaster declaration areas, and that's something I don't have time to talk about, but it is something that we qualify for here in Florida. So you may be able to get credits for mitigating, for putting on shutters and storm windows and things like that. There's some credits for that. And you'll need them with all the money that's going to the government to pay the taxes. And then for electric charging stations. Okay. So there's low-income housing credits. Those are they're opportunity credits, but they're there. The thing that's interesting about these credits is that the government controls them. They have the ability to allocate them. So if you're not part of their team, you're not going to get these credits. But if you do what they say, you will get these credits. And that's exactly how it's written. Basically, they will have the ability to allocate every year what properties will be eligible for these credits, and there is no specific test in here. All right, corporate taxation. Corporate tax rate increases to 28% from 21%. There's a 15% minimum tax. There are penalties if you invest overseas. They are and have businesses overseas. So that's why it makes sense to move completely overseas where there is no tax. All they're going to do is make that worse. There are taxes on foreign fossil fuel income. There's global intangible low taxed income for exploration that gets taxed. There's an international minimum tax. There is a tax on income derived. By the way, royalties now are no longer capital gains. There's taxes on royalties now paid to foreign countries. There are all kinds of restrictions on interest overseas. And then the big thing is enforcement. And I'm going to talk about that next week because this takes a while to get through. But I'm going to cover some of these other things. And then I'm going to talk a little bit about the IRS enforcement because this is a killer. The government will be able to get information, every bit of information that goes through any account you have of $600 or more. They'll be able to see that, all those amounts. Anyway, we're going to talk about that next week right here on Treasure Coast Solutions, WSTU Digital 1450. We are your heritage station, as long as we're here at least.